Singpost jumps to a 7-week high after the government allows it to increase postal rates. Is it a bargain right now? Let's find out. So today we're going to throw the spotlight on Singapore Post. Alright, this is a stock that has been neglected in the markets despite it being a natural monopoly in the small island of Singapore. And if you look at here, the share price literally popped up because of the news that it is working with IMDA on the postal rates. At the same time, there are other positive news surrounding the stock too. Like for example, the signing of MOU with Xiax to do a JV on e-commerce transshipment hub, which will help to shorten delivery times and reduce operating costs and manpower. On top of that, don't forget the crazy queues at Singpost to sell the Taylor Swift tickets. Aiyo, why don't they just impose a high fee to charge all these youngsters since the demand is so high, right? Anyway, coming back to the topic, given all this recent good news, is Singpost stock a bargain? Alright, so either you can sell your HDB, invest in Singpost shares like this Stephen Lim Koko here, or you can continue watching this video where I perform a quick stock analysis on Singpost. In exchange, I hope you can help me to smash the like button and subscribe to our YouTube channel for more updated stock analysis videos. And of course, to show my appreciation, here's a financial meme for you. Alright, so first and foremost, onto the stock analysis part, right? Based on the group's divisions, you can see that Singpost is more like an overseas stock because above 65% of the profits are derived from their logistics business outside of Singapore. In Singapore itself, the Singpost property is the one that really generates the income in Singapore locally, because the post and parcel segment is losing 15 plus million despite the whole company having despite the segment having a revenue of $521 million. Okay, that being said, Singpost is getting a 93 million operating profit on a total 1.87 billion revenue. That translates to a pretty low 5% operating margin, but still is profitable nonetheless. Okay, so for Singpost itself, I'm just going to go through 3 tabs over here under Simply Wall Street, right? So valuation wise, we will look at the PE ratio, and for Singapore Post itself, we are looking at 73 times PE ratio, which is crazily high. All right, and if we were to compare it to the Asian logistics industry, which I think is quite apt in the case, because majority of the operating profits are coming from logistics for Singpost. Hence, if you compare it to the industry average, it's only at around 14 times PE, and we are looking at much bigger players. We have Trancom, Sangong Cargo Service, YTO Express, you know, other kind of logistics players, CJ Logistics and all that. So I would say that just based on this comparison itself, Singpost is overvalued, right, in terms of the PE ratio. Now let's look at the dividend part. All right, so given that Singpost is the longest running company since even before the founding of Singapore, you would think that this is a stable stock, and for a stable stock, a mature stock, you will want it to pay dividends. However, when you look at the dividend criteria checks, it is giving a 0 out of 6 pointers that they need to fulfill. Okay, why? Reason being, if you look at the stats, it's really quite poor. Okay, the dividend yield right now is only 1.3%, or maybe all the way to 3%, depending on the period you want to take. But generally, because the earnings per share is coming down, the dividend per share is also coming down. So if you are saying that the postal rates are just going to increase, to maybe to normalize the impact, if you look at the segment itself, it is not contributing the bulk of the profits. So I wouldn't see a big impact to Singpost, the overall earnings. Hence, I believe that the dividend per share will not grow significantly in future too. And the third point is on ownership. Okay. And if I were to look at the top shareholders of Singpost, you would see mostly the top shareholders are all corporations. All right. The first shareholder is Singtel with around 22% stake. Okay, this must be a strategic kind of interest, way back, you know, into the past history, that kind of thing, which will not dive into that. The second part is Alibaba Group, right? So you already know that Alibaba owns Lazada, and Lazada will use the logistics network of Singpost, and that's why they decided to acquire a quite a significant ownership, like I would say, at 14%. But other than that, when we are looking at the ownership stake, right, we want to see the C-suite, okay, the CEO or COO owning at least a decent size of ownership, but we don't see it here because if any the director or the C-suite would have owned shares, right, it will appear as a human icon beside the name, but we don't see it here in the at least the top 25 shareholders. So in a nutshell, right, when I look at the different analyzing tools, be it valuation, the dividend history, and the ownership tab, it doesn't paint a rosy picture for Singapore Post. Okay, so if you were to ask me, Singpost is not a bargain stock. Okay, just simply looking at all the different aspects of the stock itself, you can see that all the numbers are underwhelming. And despite all the good news, the recent good news of signing the MOU, governments coming in to support, I do not believe that it is going to help in the play a big part in future growth of Singapore Post. And competitiveness wise, I believe the global logistics players, like Amazon and all that, they are much more efficient, and they are just operating in a larger market as compared to Singapore Post itself. Okay, so with that, if you find this video helpful for you, I will appreciate it if you can help me to tap the like button and subscribe to my YouTube channel for more Singapore and US stock analysis. And I will see you next time. Thanks for watching and ciao.